Would you drop 2 hot coffees to pick up a Starbucks gift card when you don't even know how much is on it? Probably not. But that's what a lot of homebuyers do when locking in a mortgage rate. They have a pretty good rate available to lock today. They know they can qualify for the house, but they wait a week to see if rates drop. Instead, rates skyrocket and they can no longer qualify. The point is, hold on to what you know you have instead of risking it all for a slightly better deal. So what is a rate lock? A rate lock protects you from rising interest rates while you're finalizing your mortgage. It's one of the greatest inventions in home buying. But here's what most people don't know. You're not locking in a single number, you're locking in all the possible rate options for that day. Think of it like a menu. You can choose to pay a little more up front and get a lower rate, or you can take lender credits and accept a higher rate. Either way, you're securing the menu, not just one item on it. In this example, the homebuyer could choose a 7.5% rate and get a $1,200 credit from the lender. In a week, they could change their mind because they got a financial gift from family. They choose 6.875 and pay $1,300. The homeowner can bounce around on this chart as many times as they like. They just need to make a final decision before underwriting, since rates affect qualification. So what if I wait a week? A lot of buyers think rates dropped yesterday, maybe they'll drop a little more next week. And sometimes they do, but other times they go up and fast. A borrower might want a big lender credit, so they almost choose a 7.5% option, but they wait a week and rates get worse. Now instead of their 7.5% rate giving them a $1,200 credit, they have to pay nearly $900 to get that same rate. That's a $2,100 difference at closing, just because they wanted to gamble it all on falling rates. No one can be certain if rates will drop, so capture a rate that works for you while you can. So how long do rate locks last? Most locks last 30 days, which is long enough to get most loans closed. There are other options too though, like 15, 45, and 60 days. Just remember that longer locks usually cost more. The rule of thumb is to lock in long enough to get you a few days past your scheduled closing date. Leave room for error in case of closing delays. For example, you plan on a June 15th closing date. It's May 16th, exactly 30 days until closing. You may want to lock in for 45 days just to be safe. You can extend a lock, but it's usually more expensive than getting a longer lock in the first place. So what if rates drop after you lock? Rate remorse is real, but let's break it down. On a $300,000 home with 5% down, an 8% lower rate saves you just $24 a month, about the cost of Netflix. With a $300,000 house and $20,000 to $30,000 due up front, $24 a month just isn't very much. It's best to close a loan and look for opportunities to refinance later, rather than walking away from the house or switching lenders to find a better rate. If rates drop dramatically, you may be able to do what's called a float down. But these typically only happen when rates fall at least 0.5% or more. Do rate locks cost anything? Lenders typically don't charge you a fee up front to lock. It's built into the rate and paid at closing if a fee is required. Longer locks usually cost more. For example, a 45-day lock might cost maybe a few $100s more than a 30-day lock. So in closing, don't overthink it. The best advice is to lock in your rate that you're comfortable with and that gets you the house. You can and probably will change the rate later, but you might be in that same house 5, 10, or even 20 years. For more home buying tips, visit mortgageresearch.com. If you found this video helpful, give it a like, hit subscribe, and tap that notification bell so you don't miss the next update. Have a question about rate locks? Drop it in the comments. We're here to help. Thanks for watching, and we'll see you on the next video.